Hello, Victor Lowe here, and today we'll be talking about banks. So, banks is usually a safe holding place for your money, and you can get loans from banks at low interest, say 0.9% or 1.9%. Usually the banks offer, if it's a higher amount, it's a less interest, and if it's a lower amount, it's a higher interest. So there's different accounts in banking, such as checking accounts. Usually a checking account, the bank does not give you interest, and it holds the money for day-to-day use. And it usually does not have fees for the first 100 transactions per month. After the first 100 transactions per month, then there is a 5 cents charge for each additional transaction. So, the checking account, you can transfer money from your savings to checking accounts for your day-to-day use. And savings is where the bulk of your money is held. And sometimes banks, depending on the economic climate, can give you an interest, low interest rate of 0.5% per month. So we'll talk about some investment accounts or things, such as GIC. GICs are guaranteed investments of return, like they have a guaranteed return, and those are usually held in bonds and money markets, bonds in different governments or places, such as bonds of Canada bonds, US bonds, European bonds, Russian bonds, China bonds, India bonds. There's no Africa. Africa is a national park, so. And Latin America bonds. So so GIC mutual funds are a collection of stocks, can vary in interest returns. You can lose money, but there is a lower risk of losing money than stocks, and you can get a return, but not as high a return as in stocks. So stocks are high risk, high return, high loss on penny stocks. Like those are the penny stocks are usually small businesses that try to grow, and when you put money into the stocks, they use that to invest. And you can lose money or you can make huge amounts of money, but if you lose money, you don't get your money back. That's why it's high risk. And blue chip stocks are safe investments, but are lower returns, but not always. Sometimes they're high return than penny stocks or small businesses, such as blue chip stock would be like Microsoft, Google, YouTube, Facebook, oil companies like Encana, Talisman, or Husky, and other things like electronics, like the First Andes Group, the Electronic Incorporated company, and that's what it is, like TELUS or Bell. So if you want to take out a loans for businesses, usually at like say a 2.5% interest rate, no insurance if you lose it, so you must pay back the bank in the amount of time in contract, right? So say you have 2 years to pay back your loan. You can do that with payments, and then once paid back, you don't own anything when it comes plus the interest. But if you don't pay back your loan, they can repossess some stuff like computers and stuff. But once they repossess, then you don't owe any money to the bank. So loans usually come from the bank's treasury, such as from the profits of corporate business. So the corporate business is So what to do with corporate profits is they are liable if they lose the money through loans. So and they can borrow money through the Bank of Canada at the given interest rate at that time. And this usually funds loans for small businesses. And interest rates of the Bank of... What the hell? My notes. And interest rates of the Bank of Canada... Oh, what the interest rates for the Bank of Canada is to stimulate the economy. And low interest is to stimulate the economy, and money is worth less when the interest rate is lower. And the high interest rate is to curb inflation. This means money is worth more. So we'll talk about RRSP, that's our retirement savings plan. Retirement savings plan is usually in bonds and money markets and blue chip stocks. That guarantees a safe place to put your money and get some money interest in return. So what I suggest is don't put out your RRSP in high risk stocks and high risk mutual funds. That way you lose money, or you can make money, but sometimes you lose money. So if you want to withdraw your RRSP money before you retire, there's usually a 60% tax that goes to the government. But after retirement, there is no tax and a small fee for the management of the RRSP. So debit transactions counts towards the 100 transactions per month after 105 cents at the usual. How banks make a profit is on loans to corporations or businesses on interest. I don't know, my notes are screwed up, but anyways. So we'll talk about mortgage, such as fixed terms and variable terms. So a fixed is at the given rate of interest to the Bank of Canada plus bank interest. So just say the Bank of Canada interest rate is 2% for the bank to loan. Then the Royal Bank charges 2%. Then it's 4% on interest on loan. And a fixed amount means you get your interest rate does not fluctuate with the market, and it goes for like 5-10 years. That's what you pay the interest. And what the bank does on fixed is the bank borrows the money amount all at once. At the same time, that's why it's fixed. So a variable fluctuates with the Bank of Canada interest rates and fluctuate according to markets. So the Bank of Canada says it's 1% one quarter, can lower or be raised next quarter. So the Royal Bank also fluctuates with the market interest rates. It could cost more or less to borrow according to interest rates. The bank borrows the money every quarter, therefore it fluctuates, right? The bank for the Bank of Canada or from the profits of corporations. So banks do not usually venture into business unless it's warranted. So what do banks hold money in assets? So it's usually held in gold, silver, precious metals, and cash. This ensures a tactile way of trading goods for money. And this is because money is worthless unless trading for goods. So money is a tactile way of judging how much a good is worth. Also is a tactile way to measure productivity. Unless it's not used for those two, money is worthless. So is gold and silver, but that's a tactile way to measure money. So credit cards are usually subsidiaries of banks. They allow for the purchase of goods to be paid at a later date. If you cannot pay the full amount, then you pay the amount interest. Oh no, then you pay interest on your credit card per month, but you have to pay the minimum amount. Usually, if you borrow $500, then you have to pay like $20. But the rest are like the 500. So $480, you pay interest 8% on for the $480. Okay, so my webcam is timing out, so I'll just continue this in part 2.